Every home bought with a mortgage has two prices. The first one is on the listing. You lose sleep over it. You build your life around it. You save for it for years. The second price is never written down anywhere because it isn't a price. It's a stack of payments nobody puts in front of you, and the whole stack lands on you the moment you sign. Nobody who sold you the first price is responsible for the second one, so most people don't see it coming. They meet it afterwards, one piece at a time, over months and years, under a different name each time. And every piece comes with a sensible explanation from whoever is taking it. You know what the house cost on paper. What it costs in real life, nobody ever added up for you. So that's what this is. Every hidden cost and every trap inside a mortgage in 2026. And the name of the person standing at the end of each one, because the money doesn't leave all at once. Some goes before you get the keys. Some leaves every month inside the loan, and some keeps going for as long as you own the place. One piece of honesty first, because this is where a lot of people who talk about mortgages quietly lie to you. Not every payment leaving your account is a loss. Your deposit doesn't vanish. It turns into a piece of the house that belongs to you. So does the principal inside your monthly payment. That's your own money changing shape. Everything else is somebody's revenue. So, before the keys. You spent years building one stack of money, the deposit. Nobody warns you about the second stack that has to exist next to it. And that's not my opinion. America's Consumer Financial Protection Bureau, which oversees mortgage lenders, publishes the exact document you get before closing. It splits that money into separate lines. What the lender charges to write the loan, government fees, bills paid in advance, money locked away for later. The regulator itemizes it. The people collecting it decided one total was enough for you. And if you're in Britain about to file this under American problems, Britain's official guide to buying a home and Money Helper, the government-backed money guidance service, map the same costs under different words. Product and account fees, valuation, survey, conveyancing and searches, insurance, moving, plus the tax the government takes on the purchase, which every country sets its own way. Different labels, identical functions, same direction of travel. Out. And inside that list is the line that costs people the most. It's also the one that sounds the safest. You pay for a valuation. A professional drives out, walks around, writes a report. So naturally, you think the house has been checked. It hasn't. Both regulators say the same thing. That valuation confirms the lender's security is worth what you're borrowing against. Whether the building is actually sound is a different job, with a different bill, and you have to ask for it by name. Nobody in that chain was hired to look at your roof. Skip the survey to save a few hundred, and you'll meet it later. At full price. Which brings us to the smartest looking decision in the whole process. At some point, you'll be offered a deal with no fees. The American regulator says that usually means one of two things. Either the lender covers those costs and charges you a higher interest rate, or the costs get added on top of what you borrow. Money Helper says the British version out loud. A fee rolled into the mortgage has interest charged on it along with the rest of your debt. So the fee you decided not to pay is now a thing you pay interest on. Every month. For 20 or 30 years. It wasn't canceled. It was given a payment plan. And that's the real mechanism under all of this. A cost doesn't hide by being small. It hides by moving in time. Money taken out of today comes back as a higher rate or a bigger balance tomorrow, which is why the lowest advertised rate is not the cheapest loan, and never was. Then there's the layer almost nobody prices at all, the cost of leaving. Some American products charge you for paying the loan off early. In Britain, there are early repayment charges and exit fees. And switching restarts the entry costs. New product fee, new valuation, new legal work. In the European Union, paying early is your right. But national rules can still let the lender claim compensation. "I'll just refinance later" isn't an escape hatch. It's a second transaction with a second stack. Say you get through all that, you're in. And now the house starts billing you, and it doesn't stop. The same American regulator tells buyers to budget the full monthly payment, and then, separately, maintenance, utilities, association dues, and a reserve for the thing that breaks. Britain's official guide maps insurance, ongoing repairs, and the service charges you take on with the property. And those ownership charges catch first-time buyers every single time. It's a charge you owe because of how you own the place, not what you owe on it. In America, homeowners association or condo dues. In Britain, service charge and ground rent. Across much of Europe, co-ownership charges. Monthly, indefinitely, completely separate from your mortgage. It's also why two lender quotes can look different while costing you the same. One folds your tax and insurance into the monthly figure. The other leaves them outside it. Which brings us to the biggest trap of all. One word: approved. When it lands, it feels like a verdict on you. Like an institution went through your finances and confirmed you can carry this. That's not what happened. The American regulator says it plainly. A pre-approval isn't even a guaranteed offer of a loan. And only you can decide what payment you're comfortable with. The lender priced its own risk. Nobody in that building looked at what's left of your life after the payment. Affordable is a completely different question, and you're the only one who can answer it. So before you sign anything, ask for 3 numbers, and don't accept a range. How much cash do I need before I get the keys? All of it, not just the deposit. What's the full monthly cost of this home? Not principal and interest, but tax, insurance, charges, the lot. And how much is left in my account the day after I move in? Then ask for the total you'll repay over the whole term. And compare that instead of the rate. And if you take one thing away from this, take the order. The industry runs the sum in the wrong direction. It starts with the price of a house and works down to whatever you can bear. Do it backwards. Start with your income. Take out the life you actually live and what you're saving for. Take out the reserve for whatever breaks first. Take out the cost of owning. Whatever's left is the payment you can safely afford. Only then does a house get a price. So here's the whole thing on one screen, where your home money goes. Before the keys, during the mortgage, after you move in. And who's standing at the end of every pipe? Not every line applies where you live. The map does. Buying a home isn't the trap. Being handed one price for something that charges you in a dozen directions, that's the trap. The bank tells you how much house it's willing to sell you on credit. Real affordability is knowing every place your money goes, and still being able to keep the house and the rest of your life. Every source is in the description. If this was useful, like and subscribe. This is where I take the money machines inside ordinary things apart, one at a time.